Private equity. The energy finance landscape has changed enormously in recent years. Out of the various financing methods, including project financing, Ex-Im banks, development finance institutions, bonds and capital markets, private equity represents a growing chunk of overall deal value and a bigger share of transaction volumes. In 2015, private equity accounted for 10% of global oil and gas deal value and 14% of deal volumes. Low oil and gas prices are the driving force behind the rise of private equity, pushing asset and company values down. This creates new opportunities for oil and gas sector acquisitions. In a depressed commodities climate, traditional financing sources are more scarce. Private equity fills the financing gap, offering growth capital in a cash-strapped market. Growth capital is the main way that private equity firms can add value to an energy venture. But they can also bring expertise to the boardroom and operations, and access to networks and new markets. Africa still accounts for a fraction of global PE deal value, but interest is growing, with 140 firms targeting the continent in 2016. Investors are drawn by the promise of new infrastructure, energy trade routes, and better governance, as well as lower valued asset prices. Private equity group Black Rhino, Blackstone's Africa arm, for example, has committed $5 billion to Africa energy projects between 2014 and 2019. American investment firm TPG is also boosting its presence, investing $1 billion with African firm Satya Capital. Helios Investment Partners, a leading private investment firm in Africa, acquired a 12.4% stake in Africa Oil Corp in 2015 for $100 million. As African markets liberalize, the power sector is also gaining more interest. There are now 126 independent power stations in 18 sub-Saharan African countries, where private equity is playing an increasing role. Cheap, abundant natural gas, smaller-scale power and specialized renewables projects are major motivations for private equity involvement. What's the likely impact of rising oil prices? Private equity takes a long view, and opportunities are spreading out more evenly across petroleum, trading, infrastructure, and power. Rising oil prices may open new doors, as will an increase in exit options. Overall, private equity exits in Africa hit a 9-year high in 2015, encouraged by more African institutional investing and growing capital markets. Easier exits, diverse opportunities, and still limited public markets point to greater gains in the long run. In a cash-constrained world, private equity is an innovative solution to fueling Africa's energy growth.